Today, day 5th, of this session, day 5th. Let's computation of taxable income. This is the whole story, that whole study, the whole efforts we are doing. But this again, there is a lot of topic that we're gonna go through and we will understand. But on each topic that we will dive into one by one. But most of the main idea of the tax computation we will understand. We will try to cover today's session, but it's a long session. It's a long activity that may not able to cover in this session. But hope see how much we can cover on this. Taxable income adjustment. So from where we start our computation, tax computation. The tax person or the tax consultant normally take the financial statement from the accounting team or the reporting team. Once, because as earlier also I mentioned, and we have to understand the segregation of duty between the different roles. There is a bookkeeper, there is the accountant, there is the reporting team, and then the tax consultant or tax accountant or tax reporting person. So this four stage: first stage bookkeeper, second is the accountant, the third is normally accountant we call the GL accountant. The next is the reporting, the financial statement, preparation of the financial statement. So these are the three steps before coming to the tax consultant. These three steps would be expected to be processed. And these three steps would be processed as per applicable IFRS standard. Just now one question is loss transfer. Please, first topic we will cover in detail, because even the standalone I will reply on that, may not be able to understand on that. Okay. Here now we assuming that these three steps already processed: the bookkeeping, accounting, and GL accountant, and the reporting. Now the tax consultant or the tax accountant taken the financial statement and starting to work on the corporate tax return preparation. Earlier we go through quickly this part. Now we will dive into the detail. Taxable income. As per Article 20 City Law, there is the 8 adjustment. The 8 adjustment from where we start. The computation will be started. Computation will be started from the accounting profit before tax. This is the second last item of the profit and loss. From this figure, we will take. Let me take the Once we receive the financial statement, our starting point for the computation of the corporate tax or the taxable income will be accounting profit before tax. Accounting profit before tax. And here we have, to start from that point, we require to meet 8 taxable adjustment as per the city law in accounting profit. Now, it would be 8 adjustment we might come in our mind. This is very easy. Only 8 adjustment is required, and the corporate tax return will be ready. Let's see how the 8 adjustment will come, and on each adjustment, how many further adjustment will come. Now we are drawing the picture how many the total adjustment, then under each adjustment, how many the other adjustment is appearing. We already discussed that earlier other part also, where we said the financial statement have the 6 component. but normally we are familiar with the 5 component because the statement of income and the other comprehensive income, they prepared together as per IFRS. They allow, we can make as a combined statement of the other comprehensive income also. So we have taken the figure accounting profit before tax, second last item in the income statement. Now, in this, we will make the plus and minus as per the Article 20, the 8 adjustment. Let's see. Now, from one of the 8 adjustments, okay, add back disallowed expenses and non-deductible expenses. So, disallowed expenses and non-deductible expenses, which means there are some certain expenses that as per accounting we already deducted, but the corporate tax do not allow to be deducted. Corporate tax not allowing to be deducted. So these expenses, which means already minus from the accounting, but tax authorities saying disallowed. So if already minus, which means our accounting profit is reduced. So now we have to add back, which means our accounting profit will be increased. Because these expenses, if we add back, so it will increase our tax base. It will increase our taxable income. So now our journey is start from the accounting profit to the taxable income. The whole exercise we're gonna learn today is from accounting profit to the taxable income. In between, we are discussing the many areas and many adjustment. Now the next is here, the see, let's go back. Add back disallowed expenses. There is a 12 disallowed item under this. Earlier, we are seeing 8 items, 8 adjustment we have to do. Now we are looking into the first adjustment. Under first adjustment, we're seeing the add back and disallowed expenses and non-deductible expenses. So under that, there is 12 disallowed expenses or item. So here under this 12 item, so now we'll keep tracking on this 12 item. These are already minus, we will add back to our accounting profit, and our tax base will increase, our taxable income will be increased because these expenses are already minus. Okay, now we will see the first adjustment we divided into the two. First is the add back disallowed expenses, and second is the allowed expenses. On the similar pattern, we are saying there are certain expenses that are disallowed, we have to add back. On the similar note, we have to see if there are certain expenses that may be not deducted, we will deduct now. So what we have to do, wholly and exclusively for the business purpose. If these expenses are incurred for the business purpose only, if these expenses are incurred only for business purpose, yes, we can deduct. Even in accounting, we may have the different treatment due to any reason or as per IFRS. Here the tax law is saying these are the as per Article 28 of the city law, 5 item is allowed. So we can deduct if first we here the critical point is that even the tax team, they have to understand what are the adjustment the accounting team they already made. Accounting team, because if you have the disclosure notes to the accounts of the financial statement or the accounting statement, that will help to prepare the corporate tax return. If the tax consultant or the tax accounting team is not familiar, what are the adjustment is already made, so it would be difficult. It would be difficult because the tax accountant will not be familiar what are the adjustment already made. Here is one of the example. We have to see these expenses is already deducted or not deducted. Okay. So if not already deducted, so we will deduct now. If already deducted, so no need to make any adjustment in this regard. But these are the expenses we are saying wholly and exclusively for business purpose. The reason or the rationale of these expenses only for the business purpose. But at the same time, we have to ensure not in capital nature. These expenses in previous session, we also learned not capital in nature. Because not capital nature, because if there is a capital item, the asset amortization depreciation expense is allowed. If some expenses we made for capital in nature, that will be part of the balance sheet, but depreciation over the life of the asset we will proceed. We can deduct. Okay, now the next part we have the according to the tax period. Okay, wholly and exclusively for business purpose, not capital in nature, according to tax period. Record expenses in the relevant tax period as per the matching concept or as per the accounting principle, we can say over here. What does mean? Because normally, even in the other session also, the common question from the client, all the other participants, they normally used to ask, okay, we have these expenses. So in current year, we have the huge profit and the expenses are incurred in the first week of January of 2025. Can we take back in the previous year to reduce the tax base? Now the expenses are not belongs to the 2024. If their accounting tax period is at December 2024, so they are asking the question, okay, these are expenses just incurred in the first week of January 2025. Can we adjust in the previous year? See, here we have to be ensured that as per the applicable accounting standard, all the treatment is done according to the tax period. If the expenses are incurred in the relevant tax period as per the accounting standard is permissible, so we will book over that. We may book the provision or the accrual based on the as per the accounting standard as accounting practice. The next is not in personal in nature. Okay, after that, these are the fifth item, allowed expenses as per the ministerial decision. So these are the five items that we are saying these are the allowed expenses. While if we see that some expenses, the accounting team, they put some disclosure or notes is not deducted, and the rationale of this behind these five expenses are meeting, so we can deduct. We can deduct. So these expenses we can deduct. Hope this point is clear. Now we will go back and see the here the 12 item. Okay. Still, we are on the first adjustment where we are discussing add back and disallowed expenses and allowed expenses. Now we're gonna see the disallowed 12 item. Okay, now we're gonna see that the list of disallowed expenses written in the Article 33. These are the 12 points we are discussing here. Now as we're gonna see one by one in detail what are these 12 items as per the Article 33 of the city law. Before starting that, I would like to ask you guys, hope I shared this article in the group also. Would you please confirm how many participants go through these articles? Just quickly, I wish to see the chats. Because if you seen that, go through that article, I will explain in the further considering that part also. If you did not go through, if I explain in the further details as per the article, that may be challenging for you to understand that perspective. So that's why I'm just looking your response if you already go through that or not. Yeah, the go through means just like a newspaper. You have to read just like a newspaper. I'm not expecting you guys will understand, but the idea is that it must be go through as a just we are reading the newspaper. Okay, now we're gonna start that. Now the 12 item as per the Article 33. below listed item below, this is the first item that we're gonna see, that grants and donation give to the non-qualifying benefit entities. Non-qualifying benefit entities are the qualifying benefit entities. We already seen the list on, even as per the VAT also, we used to consider such entities that are approved in the cabinet decision, or the list of approved entities for the donation or the charity purpose is already available on FTA portal. If we are already giving the donation or the charities to such approved donation bodies, so that we can deduct as in VAT also and here also. But if we are giving to the non-qualifying public benefit entities, the cabinet decision here, the list will be available, the qualifying public benefit entities. But here we are saying, apart from that, we given to any other entity, that will be disallowed. So as per accounting, yes, this is the expense. Even we given the charity to non-public qualifying benefit entities, but still we can record as expense as per accounting if the relevant standard are allowing us. But as per the city law, Article 33, this thing is disallowed. If we already deducted and we reduce our profit, accounting profit, by deducting such expenses, we will add back. So our taxable income will be increased, tax base will be increased. This is our first point out of the 12 point. Now we're gonna see the second point, interest capping rule. Interest capping rule, we already go through the interest capping rule. We understand how we are applying the 30%, the interest capping rule, but further we will also see more example, and we'll do further exercise also. What are the interest capping rule and where are we will apply? Normally the interest capping rule is 30% of the adjusted EBITDA. I'm using the word adjusted EBITDA, okay? Or 12 million, higher of 30% of adjusted EBITDA or the 12 million. So whichever the amount is higher, we'll consider that as the interest capping rule. So we already have the detailed understanding in this regard. Hope this point will be the previous exercise in the interest capping rule. Hope you can understand and what are the impact and where it will be required. So hope this point is clear. So what are the article for this? Article 29 to 31 as per city law, you can go through. This is the interest capping rule. Okay, so now here again we already learned that maximum net interest expense allowed as per the BEPS, what is the BEPS? Base region profit shifting, OECD model. Okay, so this interest capping rule, the Ministry of Finance of UAE, they taken from the OECD BEPS model. So what is this model saying, and what is the city law is taken the understanding? They covered here higher of 30% of EBITDA, but this EBITDA would be adjusted EBITDA, or the 12 million minimum safe harbor. If our net interest, what is the net interest? We already understand. If maybe we have interest income and interest expense, so we will plus minus and see what are the net interest expense. Okay, so if we have more income, net interest may be the zero. Now we have the income, so there is no deduction in that regard. But if our expenses are more, so then we have to do the calculation. And what are the formula for calculation? The 30% of higher of 30% of EBITDA and 12 million. If our interest expense, net interest expense less than 12 million, we don't have to do this calculation. We don't have to do this exercise. By default, it is allowed. So we already understand the interest capping rule, the guideline they taken from the OECD action plan, the BEPS. The BEPS do not rely on debt financing, encourage equity. So the second, what are the rationale behind that? There are many rationale. One of the rationale, they want to encourage the people put their own money into the business. They, instead of borrowing the funds from the financial institution or the other. Okay, I'll answer on that. The one of the question. BEPS, yeah, they encourage the investor or the people to add their own funds. This is the one of the reason, but the rationale is behind that because the normally, if one of the European country they have the higher tax rate, and the other country where is the tax rate is low, so how they will transfer the profit to another country? They will take the loan from the another country and then they keep paying the interest to that country. So as a higher country who's paying the interest, who borrowed the money from the another sister concern company and from other associate company or connected person, so he's actually maybe is genuine reason for the business, or as per their practice or per their analysis, they found the people shifting the profit from the high tax jurisdiction to the another jurisdiction where the tax is low. So similarly, if we seen that UAE is the corporate tax is 9%, even the effective corporate rate tax is the less than 9% because 375% is the first 375% zero rated, and plus another double tax treaty agreement, another that. So net of they may be less than 9%, maybe based on each entity, it may differ, but less than effective rate. We are saying the standard rate is 9%, but we are saying the effective rate less than 9%. Except the pillar 2, there's a top-up tax that is 15% for the MNE, multinational entities. So here the main principle to ensure that the profit from high jurisdiction will not be shifted to another country where the tax is low. One of the tool or the medium they are using the borrowing. And they borrowing, they are paying the high interest rate to another company or sister company where tax is low. Here we already seen the net interest expense, the interest expense, interest income, plus minus the net interest. Okay, now here the bullets is added. So as of now, we are looking into that add back disallowed expenses, this A part, and here we have 12 adjustment, and 2 adjustment we already go through. And now we're gonna to the next. Here are the examples that we already seen the previously. We will not spend time over here because I'm just giving the refresher, but the another part that, okay, let me complete that. Okay, here another point that I want to highlight, adjusted EBITDA. I use the word is adjusted EBITDA. Okay, before starting going through, there is one question from Ms. Farhana. I have one query for the interest ILR, interest limitation rule, as for insurance bank does not apply. That means they can, yes, for bank and the insurance companies, bank and insurance companies, for them, there is no interest capping rule. For them, there is no interest capping rule. The 100% will be allowed. Okay, because these two industries are different. So for these two industries, even the same point that you are asking on the chats, just look over here. Just look over here. Because such point I have the queries or the question from the participant or the clients. So here I just added over here. So today the main point I want to highlight, okay, let me complete. Interest capping rule higher of 30% of EBITDA at 12 million will not apply to the natural person, bank, insurance provider for qualifying. Okay, you ask only the bank and insurance. Now I am explaining to the natural person also. So here you will please note down the natural person, bank, insurance provider are the qualifying projects. Okay, we already seen the previously also. These are the 4 item, the 4 person, the taxable person, where we will not apply the interest capping rule. Interest capping rule will not apply. Interest limitation rule we will not apply. There are different names. We may familiar with a different name. So maybe it's better if we use a complete word. The other participant may understand. But just for your understanding, I'll just highlight interest capping rule, interest limitation rule. Here I already mentioned ILR. The people are familiar with the ILR also. The interest capping rule, ILR, interest limitation rule, the abbreviation is mostly I'm writing the abbreviation also in between this, like here, the brought forward, BD, credit forward, carry forward, just for understanding in between where I use in the text. Okay, now come back. Hope Farhana, your question is answered. Let's here I want to explain the adjusted EBITDA. What is the adjusted EBITDA? Because for this interest capping rule, we will use the adjusted EBITDA before exempt income adjustment. Before exempt income adjustment. Okay, we have the accounting profit. We have the accounting profit, but as in accounting profit, even the exempt income already added over there. So we will not make the adjustment. Before exempt income adjustment, he's saying that we will keep the same accounting profit before exempt income adjustment. What is that? Because maybe you have some income that is exempt as per the city, but in accounting, as per accounting, this is the income of the company or income of the taxable person. You already added. So here the point, before exempt income adjustment, we will use the same accounting profit without adjusting the exempt income, which means we will not minus the exempt income. Okay, now we use the same figure, but after making 8 adjustment into the accounting profit, means first we will do the computation of taxable income as per the city law, Article 20. So what are these 8 adjustments? These 8 adjustments we are discussing today. After doing all this adjustment, then we will take the EBITDA to calculate the ILR, interest capping rule, interest limitation rule. On which figure we will take, because the interest capping rule or interest limitation rule, as per the city law, they are referring the higher of 30% of the EBITDA or the 12 million safe harbor, 12 million safe harbor, the minimum interest that is allowed. If your interest is less than 12 million, you don't have to worry. But if your interest is more than 12 million, that even in this example, our interest expense is 35 million. If a 35 million, we have to calculate the interest cap limitation rule. We have to apply interest limitation rule. But here because the example is a simple, we have the EBITDA only. There is no other information. So we are considering these are the adjusted EBITDA. So we applied directly 30% of this. But here we are understanding we cannot go simply and apply on the accounting profit. We have to calculate the EBITDA first, then we will apply 30%, and then that 30% will be our interest limitation rule. Hope this point is clear. I would like you guys to answer on this. If this question, the 30% of the EBITDA before exempt income or 12 million, whichever is allowable expense under city law. In dash, what will be the text? I appreciate if you guys respond quickly. Thank you, Mr. Khalil. Thanks for From it to the Bukhari. Hope you guys are with me. But I appreciate all of you guys to quickly respond on that, because this will keep us active in the session. Okay. Okay, now we will go to the next point. This point I already highlighted. The main point I already explained today, the adjusted EBITDA point.